Welcome to TalkTickers. You're joining us for a deep dive into the latest earnings call from Parker. We're going to pull out the key insights you need.
Yeah, and Parker had a pretty strong third quarter, record profitability, actually, which really stands out because, well, sales were down just a little bit.
Exactly. Let's break that down. Those adjusted segment operating margins, think of that as the core profit. They hit an all-time high, 26.3%. First time over 26%.
Right, and their adjusted EBITDA margin, another key profit measure, also hit a record, 27%.
And it wasn't just the percentages. Net income, adjusted earnings per share, both record highs too.
Definitely. Plus, looking forward a bit, their order rates actually ticked up pretty nicely by 9%.
And cash generation. That ability to just bring in cash seems really solid. Cash flow from operations hit a record $2.3 billion for the year so far.
So yeah, despite that slight dip in the top line, the sales number, the financial health underneath looks, well, very strong.
Okay, let's dig into those sales numbers a bit more then. What's the story there?
Certainly. So overall sales were down 2% compared to last year. But the interesting thing, the detail there, is that their organic growth, so growth from the core business, excluding deals, that was actually positive, up 1%.
Ah, okay. So those divestitures they announced earlier, selling off parts of the business, that accounts for the entire 2% drop then.
Pretty much, yeah.
And even with that, adjusted earnings per share still climbed, what, 7%? To $6.94. That really says something about how well they're managing things, doesn't it?
It really does. A big piece of that profit story was Aerospace. Huge growth in operating income dollars there. But it's important to say the industrial businesses also pulled their weight. They hit record margin percentages too.
And it sounds like they're managing the balance sheet well. Interest costs were down.
Yep. Lower interest expense because they've been paying down debt.
Okay. And that 9% order growth you mentioned, that points to some good momentum, especially in those longer term projects.
That seems to be the case. That longer cycle strength is definitely showing up in the orders. And really, all their business segments hit record operating margins. It wasn't just one area carrying the load.
How about regionally, North America?
North America saw organic growth dip a bit, down 3%. But even with that, their margins improved to a record 25.2%.
Wow.
Which is pretty impressive given, some softness they mentioned in transportation off-highway equipment and also energy markets.
And outside North America, international.
International order rates actually looked better, up 11%. Looks like a strong recovery in those longer cycle businesses over there.
Pacific.
Asia Pacific was up 2%. Latin America saw a really strong 8% increase. EMA, so Europe, Middle East, Africa, that was down 7%. But importantly, margins expanded internationally too to 25.1%.
And aerospace, you said that was a big driver.
Oh yeah, aerospace really stood out. Record sales up 12% organically. A lot of that came from aftermarket strength, so parts and services in both defense and commercial.
That's huge.
It is, and it's the 9th quarter in a row they've seen double-digit organic growth in aerospace. Margins there hit a record 28.7%. Even new orders were positive, up 4%.
Okay, let's quickly circle back to cash flow. You mentioned the year-to-date number.
Right, $2.3 billion from operations year-to-date. That's up 8% from last year, another record. And free cash flow, the cash left after investments, that was also up 8%.
And they're returning some of that cash to shareholders. Dividend increase.
They are. A 10% increase in the quarterly dividend. Pretty significant bump. And that extends their, frankly, incredible track record. 69 straight years of annual dividend increases.
69 years. That's something else.
It is. And they also bought back $650 million of their own shares in the quarter.
Okay, so that was the quarter. Let's pivot to the outlook. What are they telling us about the rest of their fiscal year, FY25?
Well, for the full year, they're now forecasting reported sales to be down slightly, about 1%. But organic growth is still expected to be positive, around 1%.
And they've tweaked the segment forecasts.
Yeah, they raised the guidance for aerospace organic growth quite a bit, up to 12%. Very strong there.
But the industrial side?
That's been lowered. Industrial organic growth is now expected around negative 3%. That breaks down to about minus 4% in North America and minus 2.5% internationally.
And we still have the impact from selling those businesses.
Right. Those previously announced divestitures are still expected to take about 1.5% off the top line sales number.
But profitability, despite the lower industrial growth, they actually nudged up the margin forecast.
They did, yeah, just slightly. Full year adjusted segment operating margin guidance raised by 10 basis points, now at 25.9%. That would mean a full percentage point, 100 basis points of margin expansion year over year, which is quite good.
But interestingly, the bottom line, the adjusted EPS guidance for the full year, That stays the same.
Stays the same. Midpoint remains $26.70. So they expect to find that profitability even with softer industrial volumes.
And tariffs. That's always a factor.
They mentioned that. Expecting about $375 million impact from tariffs, roughly 3% of their cost of goods. But they expect to fully mitigate that, offset it completely.
Through pricing and cost control, I assume.
Exactly. Pricing, supply chain actions, ongoing cost reductions. Seems they're confident they can manage it.
And cash flow outlook for the full year.
Still looking strong. Projecting $3.1 billion in free cash flow. And importantly, a conversion rate free cash flow relative to net income greater than 100%.
What about the current quarter, Q4? Any specific guidance?
Yep. For Q4, they're expecting reported sales around $5.1 billion. That implies organic growth of about plus 1.5%, adjusted segment operating margin around 26.1%, and adjusted EPS expected at $7.75 for the quarter.
Okay, let's zoom in a bit on how they see specific end markets playing out now.
Sure. Aerospace and defense, as we've kind of hinted, they raised the full year organic growth to 12%. That's really down to that continued aftermarket strength MRO, parts, and a gradual recovery starting in the OEM side, the new plane builds.
Okay, but some other areas are softer. Implant and industrial equipment.
Yeah, they lowered that growth outlook. Now looking at negative low single digits, seems the broad industrial recovery is just taking longer than expected. Although they did say quoting activity is strong.
So potential demand is there, just delayed.
That seems to be the message. Pent-up demand, maybe.
How about transportation?
Also lowered slightly. Negative low single digits there, too, mostly due to lower car production forecasts, particularly in North America and the AMIA region, though they did say work truck demand is holding up better.
Off-highway equipment, things like construction, agriculture machinery.
That outlook actually improved a little bit, still negative, mind you, but now negative low teens, which is better than before. Looks like stronger aftermarket parts demand is helping offset some weakness on the new equipment side and maybe some inventory issues at the OEMs.
Energy.
Also lowered. Negative low single digits just reflects, lower oil prices and maybe more disciplined spending by energy companies.
Any bright spots besides aerospace?
Yes, actually. HVAC and refrigeration. They increased the growth outlook there to high single digits. Seems to be driven by real strength in residential air conditioning.
Okay, so stepping back, what's enabling this performance, especially the margins, and shaping their outlook? What are the core strategies?
Well, their win strategy is always front and center. It's their business system, really focused on operational excellence, lean, engaged people. And it keeps driving those margin improvements. They also talked about portfolio transformation. They've been using acquisitions to shift the company more towards those longer cycle markets and areas with secular growth trends, less cyclical exposure.
And lots of focus internally on efficiency, right?
Absolutely. Using simplification tools, lean initiatives, that 80-20 principle, focusing on the most profitable parts of the business, all driving efficiency.
Supply chain resilience seems key too, especially these days.
For sure. They mentioned enhancing their tools there, using dual sourcing to avoid disruptions, building resilience.
Yeah, and we touched on tariffs already. But they seem to have a handle on managing those external pressures.
Yeah, actively managing through pricing, supply chain moves, cost cuts. It's a constant effort.
Looking even further ahead, say into fiscal 26.
They believe those longer cycle orders they're seeing now should start contributing to positive industrial growth again in FY26. And they expect that aerospace aftermarket strength to just keep rolling, driving profits, even while the new aircraft build rates recover more gradually.
And M&A, still active.
Pipeline remains active, they said. Looking at various sizes, but always focused on strategic fit, making sure they can be the best owner for that business.
So capital deployment is a mix of M&A and returning cash.
Exactly. Acquisitions plus share buybacks. They're aiming to keep their debt levels manageable too, targeting a net debt to adjusted EBITDA ratio around 2.0x.
Okay, so for you listening in, let's try to crystallize the big picture here. What's the main takeaway from this call?
I think the headline is really achieving those record margins even when volumes were a bit challenged. That just highlights how strong their operations are, how effective that win strategy, their business system truly is. And obviously, that aerospace performance is a huge tailwind right now, really powering results.
And those positive order trends, especially the pickup in longer cycle orders.
Yeah.
That could signal better revenue growth coming down the pike in the industrial segments, right? Maybe later this year or into next.
It could, yeah. It's definitely something to watch. And the fact they held the full year EPS guidance steady, even while lowering the industrial growth forecast. So that tells you management is pretty confident.
Confident in their cost control, confident they can leverage aerospace and other areas to hit the numbers.
Exactly.
And finally, boosting the dividend by 10%, continuing the buybacks, that signals strong confidence in future cash generation and a clear commitment to shareholder returns.
Definitely. Okay, and now for our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea based on what we heard. So Parker's killing it in the aerospace aftermarket, right? Maintenance, repair, overhaul, MRO is booming. So here's the idea. Consider looking at companies that provide digital solutions specifically for aircraft MRO. Think about software firms, data analytics specialists, the ones helping airlines and MRO providers optimize schedules, predict failures using data, manage spare parts logistics more efficiently.
So the tech enablers behind the MRO boom.
Precisely. As fleets keep flying hard and the aftermarket stays strong, the need for digital tools to boost efficiency and cut costs in MRO should just keep growing. Could be a significant growth area playing off that trend Parker is benefiting from. But remember, this is not financial advice, just an idea.
Okay, that wraps up our deep dive into Parker's latest earnings call. We've hit the key results, the strategy, the outlook. What stood out most to you from all this? Are there specific opportunities or maybe risks that you think need a closer look? Keep these points in mind as you navigate the markets. And always, always remember to do your own thorough research.